Comprehensive answer then. Even when it comes to commodities, gold and silver ETFs have also picked up. Before I move on to the question that gold has already risen so much, YTD, year to date, will it be wise enough to invest in those funds? I'll take that question later, but if you want to, allocate some portion of your portfolio to these gold and silver ETFs, should you, first of all? And if yes, what are the parameters that you check and what portion should you be investing in them?
So the parameters are very similar when it comes to, what is the expense ratio of that ETF. Again, free websites online allow you to check this. In fact, the NSE, BSE have mandated ETF expense ratio now to be public. So you can check that out. So the expense ratio ideally should be as low as possible. The tracking difference should also be as low as possible. And again, there should be liquidity. So again, very similar parameters. And fourth is pedigree of who's offering it. So it ideally should be a bigger brand name. Now, when it comes to whether you should invest, how much of your portfolio should you invest in these commodities, I'll again go back to the basics. Instead of trying to time what is happening in the stock market, if something is going up, that doesn't necessarily make it a good investment, right? Yeah. So just from an asset allocation perspective, I think again, having 10 to 20% of your money in gold could be a good idea, right? Because it provides some cushion. This hasn't been always true, but gold at different points has performed the exact opposite of the stock market, right? So the correlation between the two assets historically at different points has been quite low. Very good example of what's happening right now, right? The Indian market has taken a beating in the past 6 months, but gold and silver have actually increased during that period. So by having, again, different pockets within your own portfolio, whether it's Indian equity, then about 10-20% in global equity, 10-20% in commodities, what that does is that during market downturns, it can keep you a little sane. It can make you less anxious because there are certain pockets of your portfolio that are doing better than others. Or inverse of that is that when certain pockets are doing well, there'll always be pockets that don't do well as well. So overall, you have to be okay with that. And I think adding gold ETFs, silver ETFs could be a good idea. Again, my preferred approach there is instead of having a gold ETF or a silver ETF, pick a gold mutual fund or a silver mutual fund. The way this works is that same mutual fund is investing in an ETF at the back end.
Correct.
So that's again, for all the reasons I mentioned before, why I prefer index funds.
Yeah.
The same reasons applies to why I prefer gold or silver mutual funds as well. And over there, one quick point, how then do you decide which gold mutual fund to invest in or silver mutual fund to invest in?
Right.
Similar principle, because with a gold mutual fund, what ends up happening is that because it's investing in the ETF, the fee that you pay is the ETF fee plus the gold mutual fund fee. So the difference in the two will be about 0.15% per year at the most. So we have to be aware of that, but I'm completely okay with paying that amount because that just helps me automate my investments. So I'm personally okay with it, and that's what I tell people around me as well.
All right, quite a comprehensive roundup. Just one last question. Now that gold has risen so much already year to date, do you think that if somebody wants to invest a lump sum amount in a gold ETF, should they, or what do you think? This is not the right time.
So if you look at the Nifty and gold ratio chart, it's not like we are at historical high levels for gold. If you compare Nifty versus gold from a ratio perspective, but that doesn't mean that gold will keep rising. There are theories that say that gold will rise. There are theories that gold will stay stagnant or even fall. Again, instead of trying to figure out what we'll do better the next time, which I am not at all in the business of, right? Because making a prediction, if you're right about it, you just look smart, but then next time you could just very well be wrong. Nobody knows what's going to happen. So I think just going back, sticking to the principles where you decide on the percentage, let's say it's 15%, right? 15% you want to invest in gold, and then just keep at it with that plan. 3 years later, let's say, instead of 15% gold being a part of your portfolio because gold has done well, now it's 20%. Right. 3 years later, you can just sell some of the gold, buy into what is not doing well. So you rebalance your portfolio that way. But again, trying to look at past returns, past 1 year returns is almost never a good idea.
Absolutely.
So,
absolutely, never a good idea for a long-term investment. And you know, that ends our conversation on a perfect note. Thank you so much, Udayan, for giving us all those insights. I'm sure this is going to help our viewers, you know, perfectly and to a lot of extent. So thank you so much for taking our time and speaking with us at NDTV Profit.